Welcome to The Explainer. I'm so glad you're joining us today because we're tackling something literally everyone wrestles with at some point. Just picture this for a second. You finally decide, okay, I'm going to be responsible. You start getting your finances in order, and you actually start saving money every single month. You stash a little bit away in a savings account, maybe $100 here, $200 there, and honestly, it feels amazing. You feel disciplined, you feel like a real adult, and it seems like you're doing exactly the right thing for your future. But then you open your banking app one day and you realize something super frustrating. Let's say you've got 10 grand sitting in there. You look really closely and notice it's earning, what, a standard 0.5% interest rate? Well, you do the math, and that means after a whole year of diligently parking that money, you've made a grand total of $50. Yeah, $50. Meanwhile, you're scrolling your feed, hearing everybody talk about investing, stocks, index funds, and compound growth. And suddenly, that $50 doesn't feel like such a win anymore. You start thinking, wait a minute, am I actually doing this wrong? Because look, while saving money is absolutely crucial, saving alone is rarely going to build you real wealth. Okay, so let's dive into the exact step-by-step path to turn that saving habit into an investing habit. Today, we're going to cover 4 things: the savings illusion, the wealth gap, our step-by-step path, and finally, reframing market crashes. Let's get right into it. Starting with part 1, the savings illusion. Now, don't get me wrong, saving money is hugely important. It takes real discipline. But believing that saving alone will somehow make you wealthy, that's kind of the illusion here. You really need to grasp that money has different jobs. Think about it. The job of your savings is simply to protect your money, but the job of your investments, that is to grow your money. We absolutely need that safety, right? I mean, you worked really hard for those dollars, but we also have to introduce market growth. Because if your money is only sitting there being protected, it's never actually out there working for you. Which brings us to part 2, the wealth gap. See, there's this massive divide, both mathematically and psychologically, between hoarding your money in a bank and actively investing it. Let's imagine a 20-year timeline, starting with that same initial $10,000 we just talked about. If you keep it in a typical savings account earning, say, 1%, after 20 long years, you'll have about $12,200. But historically, the stock market returns roughly 10% a year. If you invested that same 10 grand instead, after 20 years, you're looking at around $67,000. That is wild. The biggest wealth gap out there isn't actually between savers and spenders. It's between savers and investors. So, you gotta ask, why doesn't everybody invest? Honestly, it's not a math problem at all. It's a psychology problem. Investing just feels emotionally risky. Think of saving money like storing seeds in a glass jar. You're protecting them perfectly from the elements, but absolutely nothing is ever going to grow in there. Investing, on the other hand, is like taking those same seeds and planting them out in the dirt. At first, it's messy. They're exposed to the weather, and you can't see what's happening. But give it time, they take root, and eventually you get a harvest way, way bigger than those original seeds. Okay, let's move on to part 3, the step-by-step path. If you're sitting there wanting that harvest, but you're terrified of losing your hard-earned savings, listen, you don't have to jump into the deep end today. Instead, we're going to use a really low-stress 5-stage action plan. Think of this whole process as your financial safety blanket. It's going to help you transform from a cautious saver into a totally confident investor, completely panic-free. Let's break down each one of these steps right now. Step 1, you got to build a real emergency fund. Seriously, before you invest a single dollar in the market, you need 3 to 6 months of living expenses saved in pure cash. This money, it's not for investing. It's definitely not for jumping on some hot stock tip your buddy told you about. It is strictly for life's inevitable surprises. A sudden job loss, a random medical bill, or the car breaking down. Why is this so incredibly vital? Well, the number one reason people panic sell their investments at a loss is because they desperately need cash right that second. Having a fully stocked emergency fund literally protects your investments from your own life. Now, step 2 is all about separating your money mentally. This totally solves that psychological hurdle of risk. You need to start thinking of your money as living in 2 completely different buckets. Bucket number 1 is your safety money. That's your emergency fund, and it just stays put. Bucket number 2, that's your growth money. Because your safety bucket is totally secured, you can mentally give your growth bucket permission to fluctuate up and down. Its only job is to grow over the long haul. Let me tell you, this simple mental separation is an absolute game changer for reducing your anxiety. Moving on to step 3, start small. There is this huge, lingering misconception that you need thousands of dollars of disposable income just to start investing. No way! You really don't. These days, tons of brokerage platforms let you start with just 50 or 100 bucks. As a beginner, you really need to understand that your initial goal is absolutely not to generate massive profits on day one. Your goal is simply building the habit, building that consistency. Getting used to contributing matters so much more right now than trying to perfectly time the market. For step 4, we're focusing on simple investments. It is so common for beginners to make the mistake of jumping straight into complicated, high-stress stuff like day trading or crypto speculation. Just don't do it. Even legendary investor Warren Buffett repeatedly recommends simple, boring, low-cost index funds for most people. See, an index fund tracks hundreds of companies all at once. That gives you automatic diversification, much lower risk, and steady long-term growth. The simplest investments almost always outperform the complicated ones. It's just a fact. And that brings us to the really crucial point, which is step 5. Stay disciplined and just let the math work for you. Let's do a quick thought experiment. Imagine you diligently invest just $300 a month. If the market averages an 8% return, think about where you end up after 25 years. Over that time, you only actually contributed $90,000 out of your own pocket. But the investment growth, the compounding working in your favor, is almost $195,000. Your total sits at $285,000. The vast majority of your wealth didn't come from your paycheck at all. It came from letting compound interest do the heavy lifting. How cool is that?
All right, final section, part 4, reframing market crashes.
Now, to actually achieve that incredible 25-year growth we were just looking at, you absolutely have to survive the scariest part of investing, market crashes. If you're sitting there asking, well, what if the market crashes right after I start? The truth is, it probably will at some point. It's completely normal. They've happened dozens of times. But experienced investors view these downturns totally differently. When the market drops, your consistent monthly investments automatically buy more shares at a much lower price. You're basically buying stocks on clearance. This steep discount often leads to significantly stronger returns when the market inevitably bounces back. You just have to shift your mindset. You got to start thinking in decades, not in days. That right there is what separates true investors from gamblers. So as we pull all of this together, I really want you to remember this core takeaway. Saving money gives you stability, but investing money, that gives you freedom. They aren't enemies, they're partners. The earlier you master both, building that unshakable stability with your savings so you actually have the confidence to pursue freedom through your investments, the more powerful your financial future becomes. I want to leave you with a bit of a provocative question today to really chew on. Are you currently in the saving stage, or have you already started investing? Take a really honest look at your own finances today. Think about those seeds in the jar versus the seeds planted out in the soil. Where are you right now? And what is the very next step you need to take to move forward? Thank you so much for joining me for this explainer. I really hope this brought you some incredible clarity, and I'll catch you next time.